Welcome to week number 51. We start by looking at the COT report. As of last week, Euro longs have added quite a good chunk to continue the upward path and helping EURUSD rise as well. GBP had a little bit of a short covering over the last few weeks. That means now that GBP is a little bit more neutral. Originally there was more the bullish case because bears were wrong-footed, so the short covering pretty much neutralized the imbalance in the positioning in GBP, actually a little bit even bullish. Going forward, GBP will be trading by headlines, how Brexit is turning out. Base case really is they will be running down the clock until the very end of the year before anything is announced. But if you're trading GBP, the thing you want to be looking at is the odds. I'm using the odds check on markets. What really tumbled GBP the last few days was when the odds of a no deal rose on the betting sides as well. So around on the 10th, you can see that the odds of a no deal, you can see the odds here changing as I move about. Odds of a no deal rose to about 64%, and that really hammered GBP lower. So if you continue to trade GBP, whether it turns bullish or bearish, always have a close look at where the odds are hanging around. As it stands now, it's about 50-50. Where the weekend when we were closing, we were still a little bit more negative. It basically really means if these odds stay as they are by the time Sunday open comes, the GBP should be enjoying a mini bounce. But continuing trading GBP, you want to keep a close eye on these odds, as there will be one of the key sentiment drivers, and it saves you reading 40 articles and all these headlines through the day when they're a little bit muddy. When you look at the odds, you know what bets are coming through. It gives you better insight into where the betting markets are, and it always reflects into GBP as well. So they really move in tandem. Moving on to gold, we have a look at real yields inverted. Since the election night, real yields and gold have diverted. Basically, gold is very closely correlated, inverse correlated to real yields. As real yields drop, now I've inverted it on this chart, but as real yields drop, gold rises. You can see real yields are back to where they were in the end of August, but gold is nowhere near. So this dynamic broke apart from the beginning of the election night, and then got worse on the 9th of November when Biden was officially announced president-elect. The reason that I found out was the reason that mostly bond portfolios and gold portfolios got liquidated, and they sent most of their money down to China and invest in the Asian side. Because recently the Asian bloc and Pacific, they signed a trade agreement, which is one of the biggest trade agreements in the area, and those economies will benefit tremendously from the free trade zone. So you can see a lot of money moving towards there. But going forward, there's little reason to expect why gold should not move back up towards 1950, and that is my base case as well. Cyclically, the easiest time to do that and to buy into gold is the beginning of January. You almost always seem to get some sort of a rally in the beginning of January. But that might be the case by the time comes January, gold already rallied and the potential for upside move might be a little bit limited. So we'll be playing along with the economic data and see if there's possibility in buying gold a little bit earlier to get on that trend that it tends to have every year. Have a look at the calendar going to next week. And Monday and Tuesday we have a pretty flat calendar, all third tier data releases, nothing that I really can find a directional move out of. Looking at EURGBP, base case is that they are going to be running down the clock. That is my base case. If they are doing that, I imagine EURGBP will climb back towards 93. It closed Friday 91.50 area. Looking at the betting odds of a no deal have subsided, so I imagine EURGBP should climb back into the 90, 80, 90, 90 area, and then I would start looking for longs again towards 93 as a base case. I don't want to speculate too much into GBP USD. It's becoming very tricky, really pretty much headline driven, so we find these ranges. And looking at the COT data, this whole move here made sense because shorts were covering. Now that GBP is pretty much neutrally positioned, even a little bit more bullish, I find it difficult to really find a good directional move with as much little risk as possible. So I'll be playing this mostly by headlines. Again, looking at the betting odds of a no deal subsided a little bit over the weekend, which means GBP USD can climb back up towards 33.50. But looking at data, so on Wednesday we've got PMIs coming through from Europe, and it's incredible. Every time this PMI prints, EURUSD will make a move on the day and almost certainly will reverse it the following day. So instead of making a prediction of where this is going, I'd be much more comfortable trading EURUSD and any other of the Euro pairs on Thursday. Ideally, I think I like to see these PMIs disappoint a little bit, Euro come down, and then start thinking about long on Thursdays. Specifically even EURGBP as the theme of the running down the clock makes a lot of sense and is in line with what happened in the past with the Brexit negotiations. So I like to see a nice drop on Wednesday, and on Thursday start thinking longs EURGBP. Same thing with EURUSD. Now levels is a little bit more negotiable. It seems like this range is somewhat holding, but I won't tie myself down to a certain level. I'll be more conscious on the timing rather than the level. And then when the timing comes, the levels usually will work out as well. They kind of line up. We are somewhat in the beginning of thinking what move's going to happen next year. And we're in the middle of the month, and traditionally in FX, the middle of a month, everything's a little bit fuzzy. So you find that from the 1st to the 8th or the 9th of the month, a lot of the key moves happen. You see good strong volatility, specifically when the new quarter starts. And a lot of the macro themes and all the news data all just line up beautifully. Move towards the middle of the month and nothing makes sense anymore. Everything is a little bit muddled. All the people that wanted to take their position already did in the beginning of the month. Now we're halfway through the month, and it's really just liquidity searches. So trying to match up a lot of logic with liquidity searches is sometimes a guessing game. And that's where most of people tend to lose money, when they try to force ideas or big moves coming out in the wrong time of a month. They will leave you a little bit deflated and they will lose your money. So what we try to do is we try to position ourselves at the best tactical positions possible, and that usually means in the middle of a month is nowhere where you want to think long-term trades. It's usually in the end of the month or the beginning of the month when you know a lot of money is moving back and forward. One of the key movers for EURUSD going forward is, and has been for the most part of the year, was yuan. So the Chinese yuan is finding a lot of inflows because of their bond market and the interest rates. You can see that it's a steady fall most of the year. Actually, that fall started last year September, I believe, but you don't find media much talking about that. But the idea of inflows into China really started last year. Had little to do with COVID. Maybe COVID accelerated the whole thing. Because of that continuously fall in USD against Chinese yuan, you find that all the other currencies related to USD are climbing as well. So maybe a level in EURUSD 120, 121 seems to be too high. When you look in comparison to the yuan, it's not that extreme anymore, because the basket of USD and euro have been rebased a little bit. That means there's much more wriggle room for EURUSD to climb without pushing up any of the transactions too much. Looking at that and looking at yuan, as the yuan continues to climb against the USD, I'll show you USD as well. We expect this fall to continue continue into next year as well. So you might find a couple of pullbacks as you did here before as well. But the idea is that this continues. Now again, we're in the middle of a month, so I wouldn't trade aggressively to nip down the shorts, but as a resistance, if you see a major pullback as a resistance, about 6.68 seems to be a really good level. You saw this huge massive downside spike as well. That was on the day the election was, where it was really clear that Biden's becoming president-elect. So it's good to keep that on the back of your mind as you're thinking about trends going into next year, as you're thinking about where's the USD headed and why Euro data isn't that good, but why is Euro doing better. It's really because of the dynamic of the huge money flows going back into China and debasing most of USD. We're having a look at VIX, which is the volatility index. It is inverse correlated with the S&P 500. So if that rises dramatically, S&P 500 indices seem to see a downdraft. I'm going to switch to the monthly candle. And I want to point you out to the 20 level. For the majority of the part in the years over the most of this millennium, you see that the VIX tends to trade underneath the 20 level. That's where its safety zone, its comfort zone, if you may. Every time you see a spike up, it seems to be very short-lived, anxious situations in the market. Once things settle down, you find yourself on averaging underneath the 20 level, and that's where you see the S&P grinding out the rallies that it has been in the past few years and continues to do so. So the understanding is, as market tends to calm down again and things come together going into next year, I expect the VIX to be trading under 20 again, and subsequently you see a rally in S&P 500 towards 3,800 and so on. Now in the short term, there's a lot of jitters because of the US stimulus package. Base case is the stimulus package will not get approved until spring next year. So it could mean that in the short term you will find that the S&P 500 does play about a little bit. Worst case scenario, I don't think we're going to see anything lower in the short term until 36.90. Playing it by data, we've got retail sales coming through, we've got the Fed, they expected to do nothing this part of the year. Retail sales should come quite good, as we had good CPI. Again, it will make a little bit more sense swing trading S&P 500 on Thursday when most of the important data is mopped up, so we can see where really the market is headed. But the base case is for a more bullish pronounced move once the VIX settles under 20 as well. So it's important to understand the dynamic. We originally discussed a little bit gold. I want to show you the US 2-year yield. US 2-year yield on a bond is very sensitive to interest rate moves in the United States, and it has a very, very defined range, as the Fed made it clear they are not about to raise rates anytime soon. So you can be pretty much certain that most of this year the US 2-year yield has been trading in that range, and it's unlikely to move far much away. But what does that mean for gold? I'm going to overlay gold for you, and you can see how closely the range on the US 2-year yield affects gold. I'm going to screw it about. On the invert scale, you can see that here. So I inverted the 2-year yield. So the 2-year yield gets closer to its bottom range, as I inverted it would be the top in the picture. You should expect that gold should pick up with it. And the key event we will have for that to happen is the Fed announcement on Wednesday. So we'd like to see some sort of a bullish move from gold going into the Fed meeting and possibly beyond, as the range of the 2-year yield is pointing for that to happen. I'm gonna show you gold as well, a couple of levels I am interested in to trade, even possibly beforehand. We're in a very tight range where there's a decision to be made on gold. So in that range here, I'm expecting nothing to come out of it. And it's a bit of if and when scenario. Base case is we'll be climbing above 1852. I like to use that range as a springboard to explore towards $1,900. For whatever reason, the bond market doesn't really do what we expect it to do, and it is very well possible. It's the middle of the month and reading this scenario is a little bit more difficult. If it doesn't, then there's a good free fall all the way back to the 1780s level. So it's an if and when scenario, really tight range to play with and really defined ranges what we are looking for. Base case is up. For whatever reason we do drop behind, I'm expecting another further drop down there. Last, we have a look at USDJPY, and USDJPY is a very interesting range as well. You find that as it trades lower, you find that news headlines will say that the BOJ might, so the Bank of Japan might step in and they want to stop this aggressive downside in USDJPY as I did before in the past. But there's one thing I want to show you, which is the yen basket. So if we look at the yen basket, that basically is the aggregate basket of the yen, and it's actually trading at quite the bottom of its range in the past pretty much most of this decade. Now overlay this with USDJPY for you so you can see the massive difference. I need to invert that so it makes sense. So as the yen basket has been declining towards the bottom, USDJPY declined too. And that dynamic was mostly because of really USD rather than yen. So yen is actually becoming cheaper, it's not becoming too much expensive. For that very reason, I expect that the BOJ will be pretty cool about where USDJPY is trading, as it's not too aggressively cheap as a whole, as looking at it as a basket. I hope that explanation makes sense. Be that as it may, I'm looking for any of these levels to reject. So if you get an early rejection in the week from about this level, 140.40, I'm looking to sell rallies and explore all the way down to 102.50. If we don't make it all the way up there and start breaking down underneath these levels, I'll be still looking short towards 102.50. That's sort of the base case for USDJPY. As USD continues to decline, that would be the way forward. And we have a few data points that could give us some mini rallies. Again, we have retail sales expecting some positive reaction there. If not, we have manufacturing data. Any of these data points that gives us some sort of a bullish reaction on USDJPY. Hopefully one of these levels I'll be looking for reaction lower. Again, medium target 102.50. That would be all for me.